James Gerrish. He is joining us from Shaw and Partners. He's also the author of Market Matters. James, good morning to you. We are expecting a bit of a weak start today, aren't we?
We are indeed, Nadine. Good morning to you. SPI futures down 37 points. It was a fairly, there was some decent moves playing out in the US overnight, particularly in the US bond market. US 10-year yields are up sort of 15 basis points, and that put a bit of pressure across the technology stocks, and the Nasdaq was down 0.7%, as you just made mention of a couple of moments ago.
Yeah, so when we see big moves in the US 10-year, which we saw overnight in reaction to that the ISM services PMI, I should say, in particular. I mean, how does that sort of, does it reinforce the investment thesis that you've had thus far?
Yeah, I think it does. So I think the other thing playing out last night, obviously the ISM was out of kilter with expectations, and that drove some sell off in the bonds and push up of yields. There was a lot moving in the corporate bond market as well. So a huge amount of bond issuance right across the corporate space. So that would have played into things as well. I think one of the things that I'd be looking at from an investment standpoint here in Australia is US 10 years testing that 3.5% mark. We're at 334 at the moment. 350 is sort of that recent high. And then that will play into how we're positioning portfolios. For right now, we're staying in these floating rate income securities as well as high yielding equities. But if they do, the 10 years do go and test that 3.5, I think you can start fading that move in more fixed rate bonds.
Now, when we think about corporate activity, it's pretty quiet, obviously in the wake of reporting season. I mean, we have some investor days happening. We heard from Inside Tech Pivot, for example, yesterday from Propac. But we get into AGM season now. And I've had a few conversations lately, just insofar as we didn't get a lot of guidance still coming from companies in reporting season, but many said when it comes to AGMs, we'll have a bit more clarity, right? One of the first companies to report this year was Metcash, and it's holding its AGM today. So what new information do you think that they might be putting forth?
Yeah, that's a really good point you make, Nadine. So a lot did. They said they want to see a few more, extra weeks of trading before they put out their guidance for FY23, and AGMs are going to be, I think this year, probably more important than they have been for a while. Metcash is out today, as you made mention of. They came out in June with some pretty solid earnings numbers. So they were doing a lot better than what we've seen from these other supermarkets at their full year results. So Coles and Woolies and the like. They're all grappling with supply chain issues. They're grappling with food inflation and the like. But Metcash were doing a better job. They're also priced a lot more favourably than the other supermarkets. So there's not a lot built into that. And the other thing influencing Metcash on a positive note will be the momentum that Wesfarmers said they had in Bunnings. So in the second half of the financial year, Bunnings had really strong sales momentum. So that should flow into Metcash's sales momentum in their hardware business, which over time is becoming a greater proportion of their overall business. So we own Metcash, positive Metcash in our income portfolio for Market Matters, and hoping for some positive commentary today.
Okay, so we'll be listening in for that as well. When you think defensives, do you think that it's a little bit dangerous to be overexposed to defensive names right now, just given all of the machinations when it comes to the broader macro environment, but also when it comes to pricing power and Christmas upcoming and all of these sort of factors? Is it sort of a mistake to try to get too defensive in portfolios now?
There's always a lot of moving parts, and I'd say it depends on the position that you've got. So, in our positioning, one of the stocks we've sold recently is APA Group. We've held it for sort of the past 12 months. It's been a really strong performer for us, but everything has a price. So, the backdrop for a business like that, obviously, it's linked to US CPI in terms of their earnings. We think asset prices are probably near a peak, and rising interest rates are going to cause they're going to create a more of an issue for their future growth and funding mix going forward. So we took some profits on that one. But in terms of like defensive positionings around income securities and the like, we like the hybrid space, so floating rate notes. So I think that's an area that investors should be looking at for more defensive portfolios. So they're, a major bank tier one hybrid with 5 years to first call can yield around the 7% mark gross for franking. So I think that's an attractive return. So now that interest rates have risen, you don't have to take as much risk in the equity landscape as you once did. So portfolios can actually be more conservatively set and still be gaining a yield sort of that 6-7% mark.
Okay, and when you think about what else is catching your eye, how it's playing into your positioning, because we're feeling as if we're in a bit of a lull right now. A lot of people sort of sitting on the sidelines, really sort of reticent to make a move.
Yeah, there's always reasons not to be in the market, Nadine, and one of the key messages that I'd say is, consistency in the way you apply your approach is sort of key. And over, a couple of decades in the market, that's what I've seen as sort of the one strategy that works hell or high water. So, that's an important thing to recognise. Things that I'm, looking at the moment. Uranium stocks have been particularly strong, so we're like uranium space. We've got Paladin in our emerging companies portfolio that's doing particularly well. The lithium stocks have actually been on a tear recently, so Pilbara is one that we own in our smaller companies portfolio, and IGO is one that we own in our larger cap strategy. So they've been doing particularly well. And as I may mention before, we've put out a note this morning just on hybrid securities. A lot are going ex-distribution over the coming, couple of weeks. So there's some really, positive returns, yield returns that can be generated out of the hybrid space around 7%. You get less volatility than the underlying equity market. Plus, you're insulated from future interest rate hikes. So, a few things I'd be looking at in the market, Nadine.